thank everybody for logging and calling in today for our webinar on how to grow your retirement plan using real estate. During the seminar today, we'll hopefully talk a little bit about how you can use your IRA funds, how you can use other retirement funds to invest in real estate, different types of real estate at that, and have your IRA growing and working for you in that manner. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with Advanta now for almost 10 years, which point during this time I've spent a lot of time helping people through the transactions that we're going to talk about today with buying real estate all the way from the contract through the closing process and beyond. I've spent more the last few years focusing primarily on educating people about self-directed IRAs, and in this case, as we do today, talk specifically about real estate within an IRA account. One quick disclaimer about Advanta IRA is we don't provide any legal, tax, or investment advice for the investments our clients look to make within their retirement account. We are not permitted to dispense that type of advice. We can certainly, as we will do to the webinar today, make you aware of some potential tax issues, some potential legal issues involved when you're investing with a self-directed IRA. But as far as making a determination of whether or not you should make an investment from a legal or tax perspective, we would encourage you to talk with an attorney, talk with a CPA, who can then give you that actual advice and counsel you on what you're looking to do. And we can certainly provide names for CPAs, attorneys, other professionals who are familiar with self-directed IRAs to help give you that proper guidance. And most importantly, again, we don't provide any investment advice when it comes down to trying to decide whether or not you should make an investment, whether or not it's buying a piece of rental property, making a private loan through your IRA account. Our job is to process the paperwork and make sure it gets titled correctly. It is the job of the client and any of their advisors to make sure that the investment makes sense for them and it is something indeed that they want to do. Just a quick background on our company. We've been around since 2004, during which time we've only ever administered and provided record-keeping services for qualified money, meaning we only handle IRAs, old 401k funds. We can't handle personal savings accounts or other monies. And likewise, again, all we do is provide a record-keeping service. We do not give advice. We do not give we're not financial advisors or wealth planners or anything like that. But we offer this unique service for people who are looking outside of the box and what they want to do with their retirement plan. I think one of the advantages we have at Advanta IRA over some of our competitors is that we do have a local feel. We focus a lot of our energies and time on giving our clients the customer service they deserve. And so we've had an account manager system put in place where every Advanta account, every Advanta client gets their own Advanta account manager, one person who will assist them all the way through the transaction that they're making and beyond when dealing with any issues related to their account. As we go through the webinar today, I just want to remind anyone who's listening live and participating in our seminar live today, please send your questions to me. If you have a question for what we're going over, there's a chat box on your screen. You can type right into that chat box. Let me know any questions you have either on the slides I'm covering or something that I didn't cover. Anyone who's listening to the recorded version of this webinar today, my contact information will appear at the end. If you have any questions as we go along, jot them down and give me a call or shoot me an email with some of those questions. Now, why haven't a lot of people heard about self-directed IRAs? I think the biggest reason most people are unfamiliar with the ability to self-direct their IRA account is simply that most IRA accounts are administered by banks and brokerage firms, companies and institutions that offer them limited investment products. You can go to a bank, might have a couple different CDs and rates you can choose from. With a brokerage firm, you can probably buy a number of different publicly traded assets, but in the realm of what's allowed by the IRS and the different possible investments, those are kind of narrow institutions to follow. If you're looking simply at publicly traded assets or money markets and CD accounts, there's a lot of other things the IRS will let you do. We're going to talk about some of those today and focus primarily on real estate, people buying and selling single-family homes, raw land, etc. IRS regulations, again, are very broad. The IRS rules are limiting in nature. The IRS rules regarding IRA investments simply state what you cannot do with your IRA account. Once you understand what those rules are that we'll talk about here in just a few moments, you realize there's a lot of different things that you can invest in with your IRA account. But each custodian, whether it's a bank, a brokerage firm, or a company like ourselves at Advanta that holds alternative assets, no custodian is required to hold or to administer all of the permissible investments. So each custodian can decide what assets they're willing to handle. And that's why a lot of people aren't familiar with self-direction, because they have their accounts with a bank or brokerage firm that is only offering them or making available very certain limited investments that they can do within their IRA account. So why do individuals choose to self-direct? And again, having worked in the company for almost 10 years now and meeting a number of people who have decided to move over an old 401k or transfer over an IRA account and look to an alternative investment, some of these reasons kind of have popped up numerously over the years, talking with individuals from all walks of life. And I think some of the three reasons, the main reasons that I hear that people want to invest their IRA or their old 401k into real estate, for a lot of clients, it's simply a new source of capital or an additional source of capital. If they're looking to make an investment, buy a piece of real estate, invest in a private placement, buy tax deeds, etc., the IRA or the 401k, being able to self-direct just provides them with more money, basically other funds that they could use to make investments maybe that they already had made in the past or very familiar or comfortable with making. So for some clients, it's just a new bag of money I didn't know I had access to. When I found out I could self-direct, I'd like to use money from that source to actually make an investment. For some clients, it's the nature that when you invest through an IRA account, your gains, your income that you generate from the investments held in your IRA come into the account either tax-deferred or tax-free, depending on the type of IRA you have. So if you have somebody who is in a high tax bracket now because of their salary or their current job situation, they're having a high tax bracket, if they're making investments and they want to go buy a piece of real estate or buy into a private placement that has a pretty good return associated with it, they don't necessarily want to have that return being taxed and lumped into their current tax situation, their current tax bracket. They can make that investment instead using an IRA account and not have to worry about the taxes until they're retired or much farther down the line, when their tax rates might be much different. And for other clients, it's a notion that they feel more in control. They feel safer with this investment. The stock market, as we've seen over the last decade or so, has had its ups and downs. And I think more and more people are getting frustrated by their options within those more traditional type accounts, and also just a little weary, or leery, I should say, of what's going on in the stock market, and rather have more control over their funds, taking their IRA funds, putting it into a piece of real estate or putting it into a private investment or a private loan, and knowing that they are controlling that investment, they know what that investment is going to return to them and to their IRA account, and thus allows them to sleep a little easier at night. Now, as far as the types of assets that we see at Advance, I mean, again, we're not going to talk really about more conventional assets like your stocks, bonds, and mutual funds. But kind of the types of assets we see at Advance are really any type of real estate, whether it's raw land, could be a commercial property or a tenant in common type deal. Residential properties is probably the most common things we see at Advanta, and that could take a couple different forms. That could be a long-term rental property, a single-family home that someone intends to hold for a number of years and have the cash flow continue just to flow back to their IRA account. It could be a short-term rehab project where your IRA finds a property, has the cash to acquire it, to flip it, and then return some of that gain back into the IRA account as well. So any type of real estate, if it has a deed, can be self-directed. It's a matter of what you do with the property that you can have and face some restrictions on. We also see a number of paper assets, people lending money from their IRA account. So instead of your IRA actually acquiring and holding title to a piece of property, your IRA may lend money to someone else in the form of a mortgage loan. It might, loan to that individual. That individual uses the cash to buy the property. They make payments back to your IRA account every month or every quarter, however you determine. Basically, your IRA acting as a bank. We've also seen individuals do loans for rehabs, lending money to a fellow investor to help them complete a rehab project and then splitting a portion of the profits. We've even seen unsecured notes, kind of a rarer way that people would make an investment. Not, again, no security, simply a promissory note signed by the borrower to the IRA account promising to pay. So just a number of different things you can do in the arena of being a private lender with your IRA account. And we also see a fair number of other alternatives, and we're going to talk about today and get into the LLCs a little bit. But a limited liability companies, those are formed for a variety of reasons. We have people who've invested kind of in an LLC just with their own IRA or maybe with just a few other people to acquire a rental property or to acquire some other investment. We've also seen individuals use their IRA to invest in an LLC where their IRA is but one of 100 or 200 different investors in that particular LLC, and their IRA owns just a small share or percentage of that entity. We've also seen individuals invest in farm animals, partnerships, movie projects, equipment leasing, foreign currency trading, just again, a lot of other different things that the IRS will allow as long as you have the right type of retirement plan to make that investment. Now, the types of accounts that can be self-directed. So if you're sitting here listening to the webinar today or the recording and saying, I have money in an IRA or I have money in another account, I wonder if those funds will qualify to be self-directed. Well, any type of IRA, if you have it with a bank or a brokerage firm, if that account is indeed an IRA, whether it's a traditional or Roth account, or whether you have a SEP or a simple for your small business or maybe a small business that you work for, those funds can certainly be self-directed. So if an account has a designation of an IRA, it's a matter of simply transferring whatever amount of cash you wish from that other account to the IRA with Advanta and then choosing to self-direct. We also offer individual 401k plans for people who are sole proprietors, individuals who own their own business, who don't have employees. An individual or solo 401k plan allows you to contribute quite a bit more into your account in a given year. One area as well that we see a fair number of the new accounts that we establish come from are former employer plans, people who had a 401k. Worked for a company, they had a 403B or a 457, maybe a thrift savings plan or a pension fund. Anytime you leave your employer and you have basically a retirement plan through that employer, once you leave, you are allowed to roll that money into an IRA account, whether it's with an IRA at Fidelity or an IRA with Advanta, it doesn't matter, but you have the ability to take the money out of that plan and move it into an account that you can control. So again, any type of IRA, traditional or Roth, SEP or simple, and certainly any former employer plan can be rolled over and transferred into a self-directed IRA account. The one account on this, the accounts type that's not on this list is kind of a current employer's plan. If you are working for a company now, still employed, and you have a 401k or a 403b through them, you will have to check with the administrator of that plan to see if you were eligible to move those monies into a self-directed IRA. A lot of times, if you're currently employed by an employer, there can be some restrictions on your ability to move that money into an IRA account. So you have to check on a case-by-case basis for those types of accounts. Now, the differences between a lot of these accounts is simply the amounts you can contribute in a given year. And you can see on this slide that there's a number of different types of assets, different types of accounts here, with different numbers and different contribution limits. The IRS only limitation they place on money going into your account is how much you can take out of your pocket and put into an account in a given year. There is no restriction on earnings, and there is no restriction on moving money between your IRA accounts once it's already in there. It's only restriction on you taking money out of your own pocket and contributing additionally to your IRA account. The one account that does stand out a little bit more than the others is the Roth IRA. We do separate seminars and webinar presentations on Roth accounts because they're so unique and so powerful. The Roth IRA, as opposed to the traditional, the SEP, the simple, and the 401k, the Roth is a tax-free retirement vehicle. The contributions you make into a Roth account go in without a tax deduction for making the contributions. So the IRS deems that those funds went in post-tax, and as you invest and reinvest within the Roth IRA, your gains are all growing tax-free, and when you reach retirement age, that money actually comes out to you without any taxes due whatsoever. Now, there are a couple, you have to be 59 and a half, you have to have an account for at least 5 years before you get tax-free distributions, but for most individuals, the Roth is a very powerful device for that reason, that all of their gains are accruing tax-free. The other accounts, the traditional, the SEP, simple, and the 401k, are tax deferred. So as you invest and reinvest with your IRA, you do not pay taxes, but you will pay taxes down the line when you reach retirement age. And the reason is the IRS will give you a deduction for making a contribution to a traditional or a SEP IRA up front, so it's actually going to lower your tax base now, but the money is going to grow tax deferred and eventually will be taxed later in retirement. Now, if you have money in different accounts, how do you move it? If you have one interested in doing a self-directed IRA, you talk to your broker, you talk to your financial advisor, and they say, well, if you're going to buy real estate with your IRA, you might have a tax situation, you might have an issue. And the thing is, they're not really fully grasping what it is that you're looking to do. There are ways to move money from one IRA account to the other, or from an old 401k account, without any tax liability whatsoever. Now, the most common way that we see clients move funds into their advanced IRA account, and sometimes out of the account as well, is via transfer. And a transfer is a non-taxable, non-reportable event. It's when funds go directly from one IRA custodian to the other without the client touching the funds. So if someone set up an advanced account and wanted to move money from their brokerage IRA account, the client would fill out a transfer form. We send that to the other custodian, and they would then submit the funds directly back to us via the trustee-to-trustee transfers. And again, non-taxable, non-reportable event, and you can do transfers as often and whatever you'd like, back and forth between different accounts, again, without any tax penalty. When you have money in an employer plan, like a 401k or a 403b or a 457, and you want to move that to an IRA, that term is called a direct rollover. You would contact the administrator of your 401k plan and request them to roll over funds or do a direct rollover of funds from the 401k into the IRA. The money then gets moved directly, again, without touching your hands, directly from the 401k into the IRA. It's, again, a non-taxable event for the money to go from 401k to IRA. So, again, all the ways you can move these funds, you are not facing any tax liability whatsoever. And again, that sometimes gets lost on financial advisors or brokers who don't fully understand the back end of the process and how it works. And they think when you talk about buying a real estate in an IRA, that you're just simply going to pull the money out of your IRA as a distribution, pay taxes on it, and move forward, and actually not understanding that you can set up an IRA account with us that will allow you to make an investment into real estate through the IRA. And you can move money by transfer or direct rollover. And again, those are unlimited. Within an IRA, you can do it as often as you'd like, and most importantly as well, earnings within an IRA are also unlimited. So your rental income coming back in, or your profits on a rehab sale, there is no limitation on those funds coming back into the IRA account. So we talked about some possible IRA investments. We went through a couple slides earlier, and just to recap, again, any type of real estate, paper assets like mortgage loans, unsecured notes, and certainly a number of other categories as well, the LLCs and private partnerships. Now, when the IRS created rules for retirement accounts and for what IRAs could or could not invest in, I mentioned earlier they simply put in limiting restrictions, things they say, here's what you're not going to be allowed to do. We're not going to try to list all of the possible investments you could make. We're simply going to state, here is what you are not permitted to do with an IRA. Now, the only two investments that the IRS will not allow you to make within an IRA are either life insurance or collectibles. And collectibles would include your antiques, alcohol, artwork, collectible stamps and coins. Now, they do have an exception for gold and silver bullion and gold and silver, like American Eagle coins, where the value of the coin is simply what gold or silver is trading at. But collectible coins, collectible stamps, antiques, alcohol, etc., these are what the IRS says you cannot purchase within an IRA. They don't, again, say that you can buy real estate or that you can buy notes or that you can buy stocks and bonds. The rules laid out in Code Section 4975 simply say these are the two types of investments that you cannot make within an IRA account. Now, the other restriction the IRS places on your IRA account is that there are certain disqualified persons who your IRA cannot transact with, and certain disqualified persons who cannot receive any type of benefit from the investments held within your IRA account. And for your IRA, the disqualified persons who cannot transact with your IRA or get a benefit from the IRA include yourself as the IRA owner, your spouse, your parents and grandparents, your kids and grandkids, as well as spouses of your children and grandchildren. And they also then include any entity that is already owned or controlled by one or more of these parties as well. So a prohibited transaction then involves your IRA, a disqualified person, and then a transaction between the two parties. We define transaction, or at least I define transaction, when you think of any type of contractual deal or contractual relationships where you have people on opposite sides of a deal. Or if you picture for visual learners a closing table at a real estate transaction. Buyers sit on one side, sellers sit on the other. And if your IRA is sitting on the opposite side of the table or opposite side of the deal from a disqualified person, it's going to be a prohibited transaction. What is possible, not to muddy the waters, but what is possible is to partner with a disqualified person. For instance, if you had $50,000 in cash personally and you had $50,000 in your IRA, you could buy, as partners with your IRA, buy a property from a third-party seller using the cash from both of those sources. Now, there's some timing issues that can get a little trickier to make sure you do it correctly. That's where we would come in to at least give you some guidance, Ed, and say, here's how you need to structure it. It is possible to partner with a disqualified person, but you cannot transact with them. And again, being on opposite sides of the deal. Hopefully this next slide here will give you some more examples here of transactions versus partnering. The first one, your IRA buying a piece of real estate from your son. So your son holds title to a piece of real estate. He wants to sell it to your IRA account. That's a prohibited transaction. Okay, your son is a seller. Your IRA is a buyer. Again, opposite sides of that deal. If your IRA owns a piece of real estate and you want to lease it out to your daughter, so your IRA is on the deed, your IRA is the landlord, you're leasing the property to your daughter who's a tenant. Again, you have a landlord-tenant relationship. Opposite sides of that deal, of that relationship, that would be prohibited. Your daughter's disqualified. Your father's IRA wants to lend money to either you or your son. Again, your father's IRA is the lender. You or your son are his lineal descendants, and the borrower, again, lender-borrower, same type of relationship, going to be prohibited for that transaction to occur. If your IRA purchases real estate, so again, your IRA goes out, buys property from a third party, but then you want to have your IRA hire your son or his company to actually do the rehab, do the fix-up of the property, that is going to be prohibited as well. Your IRA is the landowner, the son or his company is the contractor. That's going to be prohibited as well. Lastly, kind of skipping down the last example, this example of a partnering transaction, if your spouse's IRA already owns a piece of real estate, okay, so your spouse's IRA has already closed on a property, owns it, and wants to sell your IRA a portion, that would be prohibited because that's your spouse's IRA selling a portion of the property to your IRA. But you change up the dynamics a little bit of that transaction. If before your spouse had actually closed on the property, you used your IRA and your spouse's IRA in conjunction to buy property from a third party, that would be a partnering arrangement and therefore acceptable. Now, what all these transactions, again, have in common is the IRA is on opposite sides of the deal from somebody who's disqualified, whether it's buyer-seller, landlord-tenant, borrower-lender, or owner-contractor. You can see those same prohibited transactions. Now, just some other things to think about. If you're going to be looking at making real estate investments within your IRA, some other things to think about. One, the IRS rules, again, state that your IRA cannot transact with a disqualified person, and no disqualified person could get any kind of benefit from the assets held within your IRA. So if you use your IRA to buy a condo, to buy a single-family home, or whatever the case may be, you are not permitted to use that property personally. Even if your IRA holds a 25% interest in a property, that doesn't mean you can use it 25% of the time. Okay, so your IRA, if your IRA owns an interest in a property, no personal use whatsoever. Additionally, the IRS will not allow you to personally do any of the maintenance work, any of the repair work associated with that property. So if you buy a fixer-upper, you're going to have to make sure that your IRA contracts with a third party and pays a third party to actually do the work to repair that particular piece of real estate. If you were to do the work yourself and have your IRA pay you, that's a prohibited transaction. Okay, your IRA cannot pay you to do the work. If you were to do the work unpaid, say I won't have my IRA charge my IRA anything for the work, then the IRS would deem that your IRA, you personally are making a contribution of your labor to enhance the value of your IRA account, and contributions to an IRA can only be made in cash. You also cannot avoid a prohibited transaction by using a middleman. So if I wanted to buy, going back to that last slide, if my IRA wants to buy a piece of property that my son already owns, it would be prohibited for my son to sell that property to a third party with the understanding that that third party is going to in turn sell it right back to my IRA account. It would be a very easy end around that rule if that was permitted. So the IRS does not allow that as well. Now, one thing we do permit clients to do if you're looking at buying the real estate is you can, as the IRA owner, select your tenants. So obviously screen tenants, decide who you want to rent to, decide how you want to rent. We have clients who do Section 8 housing, for instance, is kind of a thing for some of our clients. So you can select your tenants, decide on the rent amount. You can certainly decide on the repairs if you're buying a fixer-upper, what property you want to buy for a fixer-upper, and then also what work you want to actually do to get that property ready to rent or ready to resell. And along with that, in deciding on the repairs, also can choose the contractors. Okay, decide who you want to actually do the work. As long as that contractor is not somebody who's disqualified, your IRA can certainly hire them, and they would pay them to do the work. Again, the caveat, you can do a lot of these things. You personally just cannot get paid for any of your services that you're doing with that IRA, kind of selecting your tenants, deciding on repairs, etc. Again, as we go through the examples here, if you have any questions, please type them into your chat box on the screen. Kind of going to switch gears a little bit and go into some of the case studies and show you how the process works. What is involved when an IRA is looking at buying a piece of real estate? How is it titled? What is the relationship between Advanta and certainly the client in moving forward with a transaction? In our first example, we have an investor, John Smith, looking to simply buy a piece of raw land. He wants to raw land either to harvest the timber on it, sell off any crops, just hold it for resale. Doesn't really matter the reason why, but it's important that when the investor finds this property that the contract be written in the name of his IRA account. So John Smith will have needed to contact us to open an account, filling out paperwork to get his account established and at least get some funds transferred over to have for an escrow deposit or potentially the full purchase as well. But it's very important that on the contract, the buyer's name would reflect as Advanta IRA for benefit of John Smith's IRA number 1234. This demonstrates to the IRS that this asset, this piece of land, is owned by his IRA account. So when his IRA submits the funds to actually purchase the property, this is not a taxable distribution. This is the IRA itself as its own legal entity buying the property in the name of the IRA and funds dispersing from the IRA to actually make that investment. Similar in principle to if you had cash in an IRA at E-Trade and you were able to then go to in your E-Trade account and have your cash and buy stock in IBM or in Coca-Cola. It's the same principle involved, just a different type of asset and obviously a different type of process. On our side, in addition to seeing the contract, the client would complete a purchase authorization form, basically a form telling us what property they're buying, who they're buying it from, what the purchase price is, and most importantly for us, who the title company is or the attorney that's actually going to handle the real estate closing. And our job at Advanta is that Mr. Smith's account manager will work with the title company attorney to make sure that the IRA wording is on all of the closing documents, whether it be the HUD statement or settlement statement, the deed, etc. Our job is to make sure that his IRA is properly worded on all of those closing documents. Once we get that back from the title company, we will send the documents to the client and ask him to read and approve all of those documents. So Mr. Smith will need to look over the deed, settlement statement, title policy, etc., and initial off that he has accepted or is accepting of all those documents as prepared. And once we have his approval, the account manager will have the documents executed by an Advanta representative and will arrange for the funds to be wired from Mr. Smith's IRA to the actual closing. Now in this case study, say in 7 months, he actually receives an offer to sell the property for $40,000, the sales process is simply reversed. So instead of the buyer's name being his IRA account, the seller's name on the contract would be Advanta IRA, FBO, John Smith, etc. And again, the reverse, the Advanta account manager will again work with the title company to show the IRA as the seller on all of the documents. And the client will complete a sale authorization form directing us to sell the property. Again, the client will review and approve all closing documents before ultimately we sign the paperwork on behalf of the IRA. The sales proceeds and whatever the net gain on the settlement statement is would then be returned back to the IRA account. So this is not a contribution that Mr. Smith is making. This is a return on his investment, again, not subject to any limitations. So the title company will either issue a check or a wire back into Mr. Smith's IRA. Now, outside of an IRA, he does this same type of purchase. This would have been an ordinary this would have been taxed at ordinary income as a short-term capital gains. But because he made this transaction within his IRA, no tax ramifications to Mr. Smith whatsoever. Our next case study, talk about specifically someone buying rental property. In this case, Paul has an old 401k account and is interested in buying real estate and decides he should look for single-family rentals or condos, just wants a cash flow type asset coming back in his IRA account. He finds a house, found a piece of property he can get for about $100,000, figures if he puts an additional $10,000 worth of repairs into it, the property will be ready to rent and should cash flow about $1,100 a month after the repairs are done. So maybe he's getting $1,500 a month in rent, and then after a few expenses, he's netting $1,100 at the end of the day back to his IRA account each month. Now again, similarly to the last example with John, Paul will need to open up and fund his account by filling out our paperwork to open up application, get the account open, getting the rollover from his old 401k into the IRA, and then he finds the investment property and makes an offer to purchase. Again, we'll make sure, working with him, that the contract is in the name of his IRA. He will submit the purchase authorization form telling us exactly what it is that he's looking to buy, and again go through the same closing process that Paul has to review and approve all of the closing documents all the way from the contract through the deed and the settlement statement and any other closing documents associated with that. Our job again is to sign the closing documents on behalf of his IRA account, and we will wire the $100,000 purchase price, or including whatever closing costs may be included, to the actual title company, the attorney handling the closing. So that completes the purchase. And Paul now holds this piece of real estate as the asset within his IRA account. Now, after closing, any expenses associated with a piece of property owned in the IRA, any expense must be paid from cash held in the IRA account. So the repairs, any ongoing maintenance, property taxes, insurance, any other expense that he might have associated with that property needs to be paid from the cash held in the IRA account. Now, our job in this instance is Paul will get a bill or an invoice from his contractors, send it to us. We will then cut a check out of his account to pay expenses and pay those particular bills. Now, once Paul gets the property rented, he can have his tenant send the rent check directly to us for deposit into his account. So we will actually pay the bills out of his account as directed, and when the property is rented, the income that is generated will be sent back to us. We will deposit into Paul's account, and he can track all his activity with online statements and also through email notifications. Our system will email him automatically at the end of each day whenever there's activity happening within his account. So whether it's we paid a bill or we received a rental check, Paul will get an email letting him know of what occurred exactly in his IRA account. Now, what are some exit strategies for Paul? Well, certainly if he bought this as a rental, he could just continue to hold the property as a long-term rental. He'd be netting a little over $13,000 back into his IRA on a yearly basis. And when he sells the property down the line, he won't have paid any taxes on the rents, nor on any profits he makes from a subsequent sale down the line. Another exit strategy, he could sell the property for $150,000. He could simply basically flip the property. There's no requirement that you hold the piece of real estate for any length of time. He could turn around and sell that property a month or 2 months later, and any proceeds from that sale would simply go back into his IRA, again, tax deferred as well. He'd have more cash than go buy a new investment. Another exit strategy I've seen a few clients make as part of their investment strategy is actually he could sell the property. So our IRA has bought the property, fixed it up, and he sells it to someone who's actually going to live in the property, who gives him 20% down. So he gets $30,000 into the IRA immediately, and then his IRA will carry the balance of the purchase price in basically a seller finance mortgage note. And so he can actually get $30,000 of cash back in the IRA and then have the IRA holding a $120,000 mortgage loan. And instead of receiving rents on a monthly basis, his IRA would simply be getting mortgage payments back into the IRA account. Question just came up on our chat box, so let me go through. I don't know how many people see that on the chat box, so let me go through what the scenario is here and see if this will be prohibited or not. The question is whether or not this is allowed as a transaction or not. Now, step one would be purchasing raw land using B's IRA account, and then B and C have an LLC and wish to build rental property on that raw land. So B and C use their LLC to pay the lease for raw land to the IRA account, and the LLC then conducts rental or expense activity of the building itself. As the facts are written, it would be prohibited for B's IRA to buy that property and then lease it to basically an LLC that he and somebody else owns, and to do that work and have that LLC pay a lease rate back into B's IRA account. That would be, again, a prohibited transaction because B's IRA owns the raw land, would be prohibited from leasing that property back to B and C's LLC. Now, what could occur, and I would encourage this person to give me a call after the seminar or follow up with an email, it may be possible for the IRA to, at the outset, partner with B and C's LLC to combine cash from the LLC and cash from the IRA into maybe a new structure, maybe a new limited liability company. So this new LLC owned partly by the IRA, partly by B and C's LLC, and dump cash from both entities into that new LLC and have that LLC buy the raw land and have cash to develop any rental properties on there as well. So there may be a strategy to make that work as written. The example would not be permitted because the LLC that B owns personally would be prohibited from basically leasing that property from B's IRA accounts. I hope that answered your question. Like I said, I would encourage you to follow up afterwards with some additional questions and kind of go over that particular scenario. Now, if your IRA is short on funds, you do have a couple different options. One, you could partner. We mentioned partnering up using an IRA, using personal funds, other individuals' monies. As long as you split the income and expenses proportionally, your IRA can partner with any third parties and with any other individuals. So we've seen quite a few husband and wives both use their IRA accounts to buy the same piece of property and then split the rents and the expenses between the two IRAs. We've also seen individuals use some of their personal money and their IRA as well to acquire property from a third party, and then again splitting the income and expenses between the two. You could make your annual contribution. We have individuals who've purchased raw land in their IRA, and every year when the tax bill comes due, they don't have any cash in their account. They simply make their annual contribution of $1,000 or $2,000 into the account and use that cash to pay the bill. The third option, we don't see this very often. It can be difficult to get this type of strategy. It's allowed by the IRS, but it can be difficult to actually execute. But you can, in theory, have your IRA borrow money in the form of a non-recourse loan. Now, if you're going to borrow money using your IRA as a down payment, the IRS requires that any loan you get on that property be non-recourse. And a non-recourse loan is one in which the bank or the lender lends money to the IRA without a personal guarantee. So you personally do not sign on the note. If you were to personally sign on the note guaranteeing payment, that would violate the rules under Code Section 4975 that we talked about earlier. So in this scenario, the lender lends money to the IRA. Again, it's non-recourse, meaning the bank cannot come after the individual, cannot come after the IRA for non-payment. The bank simply can foreclose on the property. That's their only option. So the loan actually is made to the IRA from the lender, and the IRA makes the loan payment going forward. Again, it's not often that we see this done. There's some tax implications that the IRA would be subject to, and the individual would have to consider. But it is possible to do. We have had some clients do this. It's just not very often that we see it done, but it certainly is possible. And then the last case study I want to talk about, kind of switch gears a little bit, is kind of bring in a couple different aspects. One, partnering on real estate with a couple of different people using their IRAs together, and also incorporating an LLC to make that investment. In the last two examples with Paul and John, they both simply had their IRA buy a piece of real estate and had all the income and expenses flow directly through the IRA held at Advanta. Now, in this situation, we have three people, Larry, Mary, and Gary, who are interested in using some of their IRA funds to partner up with each other and go out and buy rental property. But instead of having all of the income and all the expenses flow in and out of the IRA accounts at Advanta, they decide instead to form an LLC that will ultimately own the property. So they form Real Estate Partners LLC that will list within the documents for that LLC that each IRA account is a 1/3 owner, and they're also electing to name Larry to serve as the manager of that LLC, giving Larry the ability to sign the checks, sign the documents on behalf of the LLC account. So they all open up their accounts and fund the LLC with transfers from their existing Roth IRAs. Now, in this instance, the members of the LLC are the IRA accounts. A lot of people are familiar with LLCs. The big difference with this type of structure is simply that you must list the IRA account as the actual member. So in this case, the three IRAs are listed as the members. Again, Advanta IRA for benefit of Larry's account, Mary's, Gary's, etc. And when we're doing this transaction, in the previous examples with John and Paul, before we would send money out of their IRA accounts, we wanted to see real estate closing documents because they would direct us to buy a piece of property. In this instance, Larry, Mary, and Gary are going to direct us to buy a 1/3 ownership interest in the particular LLC. So the document we will need to see is the operating agreement. Now, the operating agreement for an LLC is the document that lays out how the LLC is to be run, who it's to be managed by, how new members may be admitted, but most importantly, it's also going to list in that document who the owners or members are of that particular LLC. So that's the document that we need to see at Advanta that states each IRA is a 1/3 owner in that LLC. So again, Larry, Mary, and Gary will each open up and fund their accounts, actually going through the process again of filling out our paperwork and transferring their Roth from their current custodian into the Advanta account. They use an attorney to draft the operating agreement and form the LLC. Now, we do not require an attorney to do this, but we do encourage it. Just as a matter of a lot of times attorneys can get you that operating agreement and make sure they get you set on the right path. But again, it's not required that you use an attorney. Larry, Mary, and Gary will send the operating agreement to Advanta for review, and that's one of our functions again. As in the previous examples with John and Paul, we looked over the deed, we looked over the HUD statement, etc., make sure the IRAs were properly worded. In this instance, we're going to look over the operating agreement to make sure the IRAs are properly listed as members within that particular LLC. And ultimately, we will submit purchase authorization forms telling us, again, they're buying a 1/3 interest for $50,000, and they're going to read and approve the operating agreement and any other documents they have for the LLC indicating their approval. And again, our job is to make sure the operating agreement is properly worded, showing their IRAs as members, and ultimately sign the agreement and send money to the LLC bank account. So instead of sending money from these three accounts to a closing agent or to an attorney to actually finalize a piece of real estate purchase, Larry will have opened up a bank account for the LLC, and we will deposit the funds into that LLC bank account. So using this type of LLC, once we have funded, basically in this case they would have filled out the paperwork, the LLC now has $150,000 sitting in the bank account for the LLC. So Larry and Mary and Gary decide on property, and they will purchase that property in the name of the LLC itself. So the deed to the property will be Real Estate Partners LLC, and Larry will sign documents on behalf of the LLC. So the closing documents, again, will be signed by him as manager. Now going forward, any expenses related to that property still must be paid from the LLC bank account. So instead of having the IRAs then pay for all those expenses going through Advanta, Larry can simply use the checking account for the LLC to pay the repairs, maintenance, taxes, expenses, etc. And when the property gets rented, the rental income will be deposited back into the LLC's account. So this allows Larry, Mary, and Gary to gain even greater control over their IRA and being able to administer checks and receive and deposit income through this LLC account. Now, it's not required that they use an LLC for this example. They could have bought the property simply as one-third tenants in common and still had us issuing checks, paying bills, and receiving income. But some people have chosen to use an LLC to consolidate their holdings. Now, with an LLC, the one thing that the LLC will have to do on an annual basis with Advanta is to give us an updated fair market value. With all of our IRA accounts, we are required to receive an updated fair market value for our clients for each asset that they hold, whether it's a loan, whether it's a piece of real estate, or in this case, an LLC. Client just has to update us as to the annual fair market value of their assets. And that's what the IRS requires of us, is to report to them on a Form 5498 each year what the current value of an IRA account is. Basically, so we have to ask our clients to provide us with the updated fair market value. If it's a piece of real estate, generally speaking, we can just take the property tax bill if there's a market value there. In this case, an LLC, an unaudited balance sheet would probably suffice as well. So we had another question come up. Are there any annual fees for the IRA accounts, and is there any annual reporting requirements for the IRA accounts as well? Now, the annual reporting I just went over. We do have to get an updated value for the account on an annual basis, and we will report to the IRS that value as received from the client. Now, our annual fees for the IRA, we charge $295 a year to hold an asset, whether it's a piece of real estate, whether it's a private LLC. The $295 a year fee then includes any checks that we have to cut out of the accounts, any bills that we're paying, and also receiving and depositing any income. That is all included in that annual $295 fee. The other additional fees we have is a $50 one-time account setup fee. And we have then a transaction fee of $145 when you're buying real estate, $95 for loans or LLCs. So we have a couple of just startup fees, and the annual fee of $295 a year then covers all of the covers the asset and the account and the activity that we have associated with that. Another question came up and said, will we be getting any detail about purchasing tax liens today? I don't have any slides on it, but I will I can go over that very quickly since the question was asked. We have had clients buy tax liens. It's one of those things you have to really do your research on, and most importantly, finding out wherever you're looking to buy the tax lien. Each county in the state or in the U.S. Has different ways that they auction off their unpaid property tax bills. And for those who are unfamiliar with what a tax lien is, that's essentially what a tax lien is. Someone doesn't pay their property tax bill, the county will then auction off that tax certificate, basically that tax lien, the property tax bill, allow a private investor to come in and buy the tax lien, which gives the county then the revenue that they needed from the property taxes, and also then allows that investor to collect interest on that unpaid property tax bill. The key thing in handling an investment for us with a tax lien is really, again, going to be how that county operates. Some counties have gone to an online procedure that's very simple. We work with the client to make sure that your bidder's name and your online account is set up in that Advanta IRA for benefit of John Smith's IRA as the bidder and as the account. And we can then go into that account and submit funds as a deposit and ultimately for final purchases as well. Some counties, though, they work on an auction process where you go to or a live auction process where you go to the courthouse steps and have to make an offer right then and there and compete against other individuals. For those scenarios, it can be more difficult for us to do that. I mean, we can issue you cashier's checks, but we have found that most individuals that are looking to buy tax liens or even buying maybe real estate on the courthouse steps, it can make it be easier for them to set up an LLC like we just talked about and have their IRA funds more at where they have a checkbook control, so to speak, over their IRA account, be able to write the check directly out of the LLC. So as far as tax liens, that's really as far as deep as I would go in talking about them. It's something, again, each county has a different process for buying them, and you really want to do your research on how that process works and what all is involved. And if you have questions on it with your IRA account and how it's going to jive with what that county requires, just give our offices a call and we can let you know what our processes would be. So individually, you can get started and take control really in 3 easy steps. One, if you don't already have an account, get an account set up. At least contact us to get the application. We can get the IRA opened at least. You have an account number, and you can then fund your account once we have the account set up. Either transfer or roll over funds for the purchase or for an escrow deposit. We actually have had clients simply set up their IRA with us, people who are looking to invest in real estate or other alternatives, set up the account, transfer over just a few $1,000s into the account. Once they identify a property they want to buy, they have the cash then there for escrow. We can send the escrow deposit and then they can then transfer more funds prior to closing. Again, you're allowed to transfer between IRAs as often and whenever you'd like. So it's not an issue then to get the account set up, get some money transferred, and then once you identify a property, you can then transfer more funds later on. And so what that allows you then is that you have the account opened, you have some money there for an escrow deposit, go find the asset. Go out and look for property, put in offers. With the account set up and you having money for the escrow deposit, we would work with you to get the contract name in the name of the IRA account, get that escrow deposit sent as soon as the contract is finalized, and then go forward with the closing process. So it's actually fairly easy getting started. Just contact us to get our paperwork, and we'll walk you through those steps. That concludes our webinar today. If anyone has any other questions, please get them typed into the chat box here as soon as you can. My contact information is here on the last slide, whether you would like to email me or give me a call about your particular example, again, whether it's the more questions on tax liens, our fees, the reporting requirements, any of the prohibited transactions, anything that maybe came up during the presentation, please just give me a call or send me an email and I'll make sure I respond to you. Another question came up, will the slide presentation be available? And the answer is yes. I will be sending out later today a copy of all of the slides as well as the recording link to anybody who either participated or was not able to participate in the webinar today. So you will be getting a copy of those slides later this afternoon. I would encourage you as well, go to our website at advanceira.com. Any other upcoming events, seminars, webinars that we're going to hold at Advance are always listed on our website, as well as just a lot of other really good information on self-directed IRAs and what is possible when you open up your mind and look to do different things within your retirement account. So at this time, I'm going to conclude the webinar today. I appreciate everybody listening in, and please contact me going forward with any other questions that you have. Thank you.